Hi everyone. In this video, I'd like to discuss few things about chapter 14. I'm not going to cover everything. There are some definitions that you need to study and know them for the test and for the assignments, like how we define money, the functions of money. So I'm not going to actually spend time talking about them because they're pretty straightforward definitions that you need to know. And they're really, really easy to read on your own. You need to know the definition of money, the functions of money. As I mentioned, these are the three important functions of money. You might find other um, functions of money in other textbooks, but we're going to follow our textbook. So these are the three important functions of money: medium of exchange, meaning that you can purchase anything with money; unit of account, you can put value on different goods and services using money, and a store of value. So if you keep your money, you can spend it in the future. So these are the three important functions of money. Read them in more detail, okay? All right, so now let's talk about money that we have today and some of the important terminologies that come with it. Again, they are pretty straightforward, that you can even read them on your own. So again, I'm not going to spend that much time talking about them. So we call actually the money that we have, that we know today, as a fiat money, which is nothing but the currency and the deposits we have in the bank. So the currency is the dollar bills, the coins that we have that are circulating basically in our economy. And there are also different types of deposits we have at the bank, at the financial institutions, like your saving accounts, your the money you have at the credit unions that you have, different types of banks, different types of financial institutions. All those deposits plus the currency are called fiat money. There are two official ways of measuring the money that's circulating in the economy, or we call it supply of money or money supply. There are two big categories we have here. They're called M1 and M2. The Federal Reserve, as the central bank in the United States, is in charge of basically measuring how much money we have in the economy. And this is basically how they measure the money and how they classify the supply of money. The first category is called M1, which is the currency, the checks we have, the checkable deposits that basically is circulating in the economy by individuals, businesses, firms. And the other one, which is bigger than M1, is called M2. M2 is M1 plus other different types of deposits we have, like saving deposit, time deposit, money market funds. If you are taking any finance or other business courses, you'll learn more about money market funds. We're not going to talk about it that much in econ. However, you are an econ major, you might learn more in your more advanced macro classes, but we're not going to talk about it here. Remember that there's a difference between saving deposits, checkable deposit, and time deposits. So checkable deposits, briefly, they don't earn any interest rate. They have basically zero interest rate. They don't earn any interest over time. They are connected to your debit card, or you can basically write checks with them. To withdraw money, you can use your debit card or you can write a check. So they are pretty liquid, as we say it in econ. So you can basically purchase anything with your checkable deposits. It's super easy to use it, to have an access to your checkable deposit. Saving deposits are those deposits that they actually earn interest and they have a positive interest rate. Right now, the interest rate on saving deposits is pretty low. But if they are high, actually people have some incentives to open a saving deposit and leave their money in the saving deposit because it's going to earn the interest over time. They're not as liquid as checkable deposits. It takes time for you to purchase goods and services with your saving deposit. You should either withdraw money directly from saving deposit, or you should transfer your money from saving to your checkable deposit and then use your money. So it's not as liquid as checkable deposit. Small time deposits are those deposits that actually you leave the money in the bank and you're not going to touch it for a little, like let's say for 6 months. They're called small deposit, small time deposits. So for a little while, you're going to leave your money at the bank and you're going to earn interest for it. You cannot withdraw money while you're having this the small time deposits at the bank. Their interest rate compared to the saving deposit typically is higher, so you have more incentives actually to open those type of deposits. They are not, again, liquid because, again, you should go to the bank, withdraw the money, and typically if you withdraw money before the due time or the deadline, you're going to actually lose the interest on the deposits. Okay, so they're not as liquid as checkable deposits. So all different types of deposits belong to M2. Okay. Now let's talk about the monetary system we have in United States. So we have a Federal Reserve at top of the monetary system as the central bank in United States. And then we have other banks and financial institutions that basically the Federal Reserve manages them. The Federal Reserve comes up with different monetary policy for them. So we have the Fed at the top of the monetary system, and then we have banks, credit unions, and other financial institutions that provide different types of services for us, for individuals, for businesses, even for government. So this is kind of the monetary system in kind of if you want to visualize the monetary system. So we have the Fed at top, and then we have all these financial institutions like commercial banks, thrift institution, money market funds, that they are actually in charge of circulating money in the economy. Remember that the Federal Reserve doesn't provide services for individuals and businesses directly. Federal Reserve is only going to provide services for financial institutions and banks. So if you want to get money, you cannot go to the Federal Reserve because Federal Reserve is a central bank, but you can go to a commercial bank, okay? Or if you want to get a loan, you cannot go directly to the Federal Reserve. However, banks and financial institutions can actually go to the Federal Reserves and borrow money from the Fed. That's the job of the Federal Reserve, to support banks and financial institutions, but not the individuals and businesses, okay? So now let's talk a little bit about the financial institutions briefly again. So we have commercial banks. So commercial banks are the generator of monetary system in terms of providing money in the economy, because they accept our saving deposits, and they give those saving deposits, those money to investors in the economy by basically issuing different types of loans. That's the main way for them to generate money in the economy, okay? We have, I put some examples for you here. We have 8,600 commercial banks in the United States. We had more, of course, commercial banks in the past, but due to different recessions that we experienced, many of these commercial banks actually merged over time. They are in charge of, as I said, creating money in the economy. Circulation of money actually is coming from these commercial banks through the savings, individuals' savings, that is called nothing but the bank's reserves, okay? So they keep all these reserves and then they create loans and give it back to people, the investors in the economy, or businesses or individuals, doesn't matter. Now let's look at some important terminologies we have that we're going to actually use them in the future. The first one is called required reserve ratio. So all the commercial banks, all the financial institutions, credit unions, they have to put money aside at the Federal Reserve, and it is called required reserve ratio, okay? So if you are a bank, if you're a commercial bank, you have to, by law, you have to put minimum percentage of your deposits at the bank, okay? Whatever you have, the minimum percentage of that money at your bank will go to the Federal Reserve. That money is called required reserve ratio. So the Federal Reserve is going to keep that required reserve ratio, and it's for the time that, let's say, commercial bank is not basically doing its job, or because of recession, they file for bankruptcy or whatnot. So then the Federal Reserve actually might be able to use this required reserve ratio and basically provide some sort of money and services to individuals that have accounts at that commercial bank. Okay, so it's some sort of a guarantee for clients and customers of commercial banks and credit unions. Another reason that we have the required reserve ratio is one important tool for the Federal Reserve to control the supply of money. We will see, of course, how. Okay, so by law, banks and financial institutions definitely should keep some parts of, or some percentage of, their deposits at the Federal Reserve, and it's called required reserve ratio. Okay. Another important definition we have here is the excess reserve. And it's when commercial banks or any financial institutions, for that matter, they have actually extra money. So they have some deposits in the bank, and they give some parts to the Federal Reserve in terms of required reserve ratio. Whatever they have is called excess reserve, and they can do a lot of things with these excess reserves. They can give it as a loan to their clients. They can even lend it to other commercial banks that they are kind of short in money through this interbank loan market. Another name we have for it is federal funds market. So let's say Chase, which is a commercial bank, has excess money, has extra basically funds. And then we have Bank of America, who is short in money. Bank of America has two options here. Bank of America can go directly to Chase and borrow money, okay, and pay an interest rate to Chase, right? Because nothing is free. This interest rate is called federal funds rate. Another option that Bank of America has is to go to the Federal Reserve, because Federal Reserve is a central bank, and borrow the money directly from the Federal Reserve. That money, the money that Bank of America is now getting from the Federal Reserve, again, comes with an interest rate. That interest rate is called, let me show you, and then I'll go back to that slide. It's called, if I can just find it, that money, I cannot find it anywhere. That money is called discount rate. Okay, so discount rate is the interest rate on the money that commercial banks, or on the loans that commercial banks can get directly from the Federal Reserve. Okay, so let me go back again. I thought that I had the definition right after this slide here. Sorry about that. Just wanted to show you the discount rate. The definition of discount rate I'm going to show you later. Okay, I don't want to jump again. So so remember, Bank of America here in this story had two options: getting the loan, because the Bank of America doesn't have enough resources, enough reserves at the bank. So the Bank of America can go to the Federal Reserve, get the money directly from the Fed, pay the interest rate, it's called discount rate, or it can go to another commercial bank like Chase, who had excess reserve, borrow the money from the Chase and pay the federal funds rate. Okay. So note these terminologies. Okay, so I'm talking about two different interest rates. Which one at the end of the Bank of America will end up with? It just depends on the interest rate. If the federal funds rate is lower than the discount rate, so Bank of America will go and get the money from Chase. If the federal funds rate is higher than the discount rate, then the Bank of America will get the money from the Federal Reserves directly. Okay. Again, remember that these federal funds rate, the discount rate that we're talking about here, they are again important policy tools for the Federal Reserve to control the supply of money in the market, okay, in the money market, okay? So don't forget that. That's why we're actually introducing all these terminologies here. Another thing that commercial banks basically keep besides the reserves and loans that they have, and another way that they can also make money is through the federal funds market by basically lending money to other commercial market, is securities and loans. So they can have bonds that are issued by the government, and they earn, of course, interest over them, or they can also own bonds that are issued by some big companies. So they are commercial banks' assets. Also, they basically give loans to individuals, businesses, sometimes even huge companies and government. So again, they earn interest through these loans. These are all commercial banks' assets and different ways that the commercial banks basically can make money. Okay. We have also in that monetary system that I showed you, we had commercial banks, we had thrift institution, and then we have money market funds. Now we talked about commercial banks. Now let's look at the thrift institutions. We have different types of thrift institutions. You really don't need to know all the details about them. We have saving and loans associations. These are the financial institutions that they pretty much come up with any different types of loans that you can think about: personal loans, commercial loans, home purchase loan. They have all different types of loans, and they are actually big institutions. We call them saving and loans, or SNL. They have saving banks. They are smaller than SNL. They do not have all different types of loans. Both savings banks, and also SNL, they accept saving deposits, but it's only SNL who also accepts the checkable deposits. Saving banks do not have the checkable deposits. Some of them, if they merged with another saving bank, they sometimes offer, they sometimes accept checking deposits, but again, they're called savings banks. So they typically, not always, they have saving deposits, but sometimes they also accept checkable deposits, if that makes sense. I know I repeated a lot. In terms of giving loans, they do not have that luxury of having all different types of loans that we have for SNL. They typically have home purchase loans and in personal or consumers loan. And then we have credit unions as another type of thrift institution. So they're definitely smaller than SNL and savings bank. They really don't have that many types of loans because they are smaller, so the resources are smaller. They are typically owned by a small group of people. They are they're definitely smaller. They do not have that many resources, and the only type of loans that they have is just personal or consumer loans. Okay, so they're pretty small, and they only offer saving deposits. However, I know some credit unions that also accept checkable deposit, but there are not that many. Okay. And again, we're not going to talk about money market funds, okay? But you will learn more if you're taking any finance course, okay? So we had for the money market, for the monetary system, we had the Federal Reserve at top, and then we had all these commercial banks, thrift institutions at the bottom. Now let's look at the Federal Reserve and the structure of the Federal Reserve, and then we will talk about money market, which is also an important part of this chapter. Okay, so the Federal Reserve is a central bank in the United States, as I mentioned, and I put some the history for you here. You can also learn more if you just Google the history of Federal Reserve. Federal Reserve is in charge of all the monetary policies in the United States. The Federal Reserve controls the supply of money and the interest rate. We have one head of Federal Reserve, which is located at the at Washington D.C., and then we have 12 regional Federal Reserves, okay? And it's because of the size of our country. And you can see in this map basically where each Federal Reserve is located. We have a pretty unique shape for our Federal Reserve, and unique system, I should say, for the Federal Reserve. And probably we are kind of an exception in terms of having such a huge Federal Reserve, a central bank. So we have Federal Reserve in Texas, in Dallas. In Dallas, we have one in Chicago, St. Louis, New York, Boston, San Francisco. So as you can see, we have 12 regional Federal Reserve, okay, or Federal Reserve districts. But the head Fed is in DC because we have the Board of Governors in DC, okay? So now let's look at the structure of the Federal Reserve. So we have the chairman of the Federal Reserve. We have the Board of Governors, we have 12 regional Federal Reserve, and then we have the heart of Federal Reserve, which is called FOMC, or Federal Open Market Committee, okay, which is in charge of issuing all the important policies that is coming for money markets, okay? So the main part of the Federal Reserve, the important part of Federal Reserve is this FOMC, okay? So the chairman is basically the spokesperson of the Federal Reserve. The chairman is also, according to many people, is the second, probably the second powerful person in the United States after the president. Because as I said, the chairman or the chairwoman is the face of the Federal Reserve, and all the important decisions in regard to the interest rate, supply of money, and the money market should be approved by the chairman. And I tried to put some background and important, basically, chairperson of the Federal Reserve here for you. And the current chairman is Jerome Powell, which was elected by President Trump, and he's still in charge of the Federal Reserve. And remember that the chairman typically is somebody who's going to be in charge for a couple years at least. And the presidents of United States try to pick a person who can get along for both parties, Republican and Democrat. And probably President Trump was the outlier here for changing Janet Yellen pretty quickly, because the president is not going to necessarily change the chairman of the Federal Reserve. Because again, as I said, they tried to come up with choose a person who is kind of liberal, but President Trump changed Janet Yellen as soon as he took office, okay? But Mr. Powell is still in charge of the Federal Reserve. However, President Biden is now in charge, okay? Anyhow, a lot of information for you. You can read it. Now let's talk about the Board of Governors, okay? So as I said, we have the chairman, who is the head of the Board of Governors. All the important decisions should be approved by the chairman. In the Board of Governors, we have 7 basically members. They are all assigned by the President of the United States, but the Senate should approve them. They have 14 years, as you can see here. We have 12. I don't want to spend that much time. You can read all these slides. We have 12 regional Federal Reserve. I showed you their district on the map. Each regional Federal Reserve has 9 directors. Again, 3 of them are appointed by the Board of Governors. I'm just reading from the slide. And then 6 are approved by the local commercial banks, okay, in that district. After the chairman, probably the second important person inside the Federal Reserve is the President of New York, because you will see that all the important activities that the Federal Reserve basically issues in terms of changing the interest rate in the market is going to be actually led by the President of New York. So the President of New York actually is in charge of most of the policies that the Federal Reserve basically wants to issue, okay, like the decisions that come from the FOMC, all right? So what is FOMC? Federal Open Market Committee is basically the heart of the Federal Reserve. All the important decisions, as I mentioned earlier, is coming from and should be approved by the FOMC. So inside FOMC, obviously, we have the chairman, we have the Board of Governors, and also the President of New York. That's why the President of New York is very, very important person in the Federal Reserve, because it's always there. But another thing that is kind of, so the chairman, the Board of Governors, and the President of New York, they're always there. But we also have 4 other members in the committee, 4 presidents of regional Federal Reserve. They have their positions in the FOMC on a kind of annual rotating basis, so they are not there all the time, but they can actually, if they want to change something, of course they can. If they are not, let's say the president of Dallas is not this in 2021 is not part of the FOMC and has some requests and have suggestions, definitely they can make a proposal and send it to FOMC, but they don't have obviously any voting rights, but they can send their thoughts and their requests to the FOMC. But they have this kind of annual rotating role in the FOMC, okay? So as you can see, the important people in FOMC and in the Federal Reserve are chairman, the members of Board of Governors, and also the President of New York. The other people, the other 4 members of the FOMC, they are not there all the time, as you can see, okay? Now let's talk about the Federal Reserve important policy tools. We're going to learn how these policy tools work when we talk about the money market. So there are 3 important. We have actually more than these tools, just to let you know, but we're just focused on the important ones here. But if you are an econ major, and or even if you look at other textbooks, you might find more policy tools for the Federal Reserve. So we have the required reserve ratio. Just to kind of refresh your memory, required reserve ratio was the minimum percentage of commercial banks should be held at the Federal Reserve. We have the discount rate. Discount rate is the interest rate on the loans that commercial banks or thrift institutions can get directly from the Federal Reserve. And then we have the open market operation, which is nothing but buying and selling government bonds, okay? I'm just going through the slides. We've already talked about them. So this is the open market operation, probably for the first time. Let me also show you the discount rate. This is a discount rate that I was talking about, all right? Open market operation is probably the most important policy tools for the Federal Reserve, and probably the easiest way for the Federal Reserve to change anything in the money market is through the open market operation. And another important thing that I should tell about the President of New York is that the President of Federal Reserve in New York is in charge of leading this open market operation. Okay, what is open market operation? As I said, it's just buying and selling government securities. Remember, the government securities are Federal Reserve's assets. So the Federal Reserve has the right to sell them anytime that it wants, okay? And the easiest way for the Federal Reserve to change anything in the money market, as I mentioned, is to sell or purchase these government securities, okay, to the public, okay? That's the easiest way for them to change the supply of money and interest rate. And again, the Federal Reserve of New York is in charge, okay? So supply of money, I use this terminology, supply of money, or the money supply. What is it? Another name for it is monetary base, by the way, is nothing but the amount of coins, dollar bills, the bank's reserves, at the Federal Reserve. So all this money basically we have in our economy, in our money market, is the supply of money. So the money you have in the bank, the money that commercial banks put in the Federal Reserve, the dollar bills, the coins, they're all called supply of money or monetary base. Every time that the Federal Reserve changes something in the money market, every time that the Federal Reserve changes the discount rate, the Federal Reserve changes the required reserves ratio, you will see the impact on the supply of money, okay? To understand how the Federal Reserve controls the supply of money, we need to learn about the money market first, okay? So now let's look at the money market, then we're gonna come back to these policy tools that we introduced and see how the Federal Reserve can change the money market using all those tools that we just named and defined, okay? So let's now talk about money market. This part is a little bit different from your textbook, and it is not in chapter 14. I brought it from, I believe, I want to say chapter 16, but I'm not sure. You can check the textbook, but it is not in chapter 14. So I'm bringing it from another chapter, but you can follow my notes. And of course, if you want to learn more, you can always go back to the textbook. It's always a good idea actually to check the textbook. Let's talk about demand and supply in the money market. So just like any market, the money market has both sides, demand and supply, right? So let's talk about demand, and then we will talk about supply. And you will see that we have kind of a unique shape for the supply of money. The demand is very kind of straightforward, just like chapter 3, just like if you remember in chapter 12, we talked about aggregate demand, aggregate supply. So we have kind of a typical downward slope shape for the demand for money, or MD, but you will see that the supply actually is kind of unique. So the demand for money is nothing but, again, the relationship between quantity demanded. Since we're talking about money, it's called quantity of money demanded, and the price in the market. The price in the market is interest rate, okay? So the demand for money shows the relationship between quantity of money demanded and the interest rate. What is quantity of money demanded? Obviously, the quantity of money demanded is the amount of money that individuals, businesses, firms basically hold, okay? How much we hold as an individual, as a business owner, it depends on the interest rate, right? So the quantity of money demanded is how much money you have, how much money you decide to hold, which depends on the interest rate, okay? What is the interest rate here? What is the definition of interest rate? Interest rate is the opportunity cost of holding money. If the interest rate is high, okay, in the market, if the interest rate is high, then you are going actually to hold less money because you can use your money to purchase the stocks and bonds because the interest rate is high. You can put your money aside in the saving bank at the in the saving account at the bank because you can earn actually more interest, right? So the amount of money that you are going to hold or the quantity of money demanded will go down, right? Vice versa. If the interest rate actually is low, you don't have that much incentive to open a saving account or purchase bonds and stocks. So actually you are going to hold your money. So we have this inverse relationship between interest rate and the quantity of money demanded. That's how much money you are going to hold, okay? Let me just clarify what I'm talking about when I say interest rate. As you can see here, the interest rate that I'm talking about is called nominal interest rate. Again, if you're going to, if you're an econ major, you are going to take more advanced macroeconomics. So you're going to learn more about nominal interest rate, real interest rate. But the concept is very similar to what we had for real GDP and nominal GDP. The interest rate that I'm talking about here in terms of the relationship between quantity demanded and the interest rate that I just talked about, I'm talking about nominal interest rate. What is nominal interest rate? Nominal interest rate is the interest rate at the bank, okay? So you open a saving account and the nominal interest rate is, let's say, 5%, which is pretty high. It's close to zero right now. So that 5% is the nominal interest rate. In that nominal interest rate, in that 5%, we are not considering the inflation rate, okay? So if the inflation rate is, let's say, 2%, okay? So the real return on your money in that saving account is just 3%. But the bank is just telling you that the nominal interest rate, that the interest rate is, the interest rate is 5%, but it is not telling you how much you really going to earn from your money if you put your money in the bank, in the saving account, okay? Because we're not considering the inflation rate, okay? So if the interest rate, if the nominal interest rate that the bank is announcing is 5%, and let's say the inflation rate is 2%, the real interest rate that you are going to get from your money at the bank is just going to be 3%, okay? But whenever we talk about money market, the interest rate is the nominal interest rate, okay? So it has inflation rate inside, okay? So from now on in this chapter, when I say interest rate, I'm referring to the nominal interest rate, okay? Not the real interest rate, okay? So anyhow, we were talking about demand for money or money demand or MD. So we have this inverse relationship between nominal interest rate and the quantity of money demanded. So that's why we have a downward slope MD, typical shape for demand, right? So remember, if interest rate is higher, your interest rate is nothing but the opportunity cost of your money, right? So if the nominal interest rate is high, you are not going to hold that much money. So the quantity of money demanded will go down and vice versa. If the interest rate is low, nominal interest rate is low, you are going to hold actually more money. So the quantity of money demanded actually will go up because you have less incentives to put your money in the bank or purchase bonds or stocks, okay? So if the interest rate changes, just like chapter 3, there is no shift in your money demand. You're just going to move from one point to another point on your money demand curve. But if anything other than interest rate changes, like the price level, like real GDP, financial technologies, your money demand can shift. If your money demand increases, it will shift to the right. If the demand for money decreases, your money demand will shift to the left. Just the same rules as the same rules we had in chapter 3. for demand and supply. So now let's talk about how these factors can shift our money demand. If remember price level, we defined it in chapter 9. So if everything becomes more expensive, definitely you are going to hold more money, because you need actually to have more money in your bank account, because to purchase the same amount of goods and services, you need to have more money. So if price level increases, the demand for money will increase. So MD will shift to the right. If the price level decreases, as everything becomes less expensive, you are going to hold less money. So the demand for money will shift to the left. Real GDP. If real GDP increases, remember real GDP is the total income, right, for the economy. So if real GDP increases, it means that people have more money to spend, right? So they are going actually to demand more money. So if real GDP increases, the demand for money will go up for sure, because people are going to spend more money. Their expenses is going to go up, so they are going to need more money for that. And again, vice versa, if there's a recession and real GDP decreases, the demand for money will go down, because people don't have that much money, because real GDP is the income. The expenses will go down, the expenditures will go down, so real GDP decreases, demand for money will go down, will decrease as well. Financial technology, what we mean by that? We mean basically how you're going to spend your money. Are you going to use your debit card? Are you going to use your credit card? You're going to use checks for your transactions or not? So depending on basically the method of payment that you have, your demand for money will change. If you are going to use your credit card more, so your demand for money actually is going to go down, right? So you don't necessarily have to have the money when you use your credit card. You are going to pay, of course. You're creating a debt for yourself that should be paid in the future. But right now, if you want to use your credit card, your demand for money actually will go down. If you don't have a credit card, or you just don't want to use your credit card because you just want to have that balance in your life, you don't want to spend more money than what you're making, so you're going to rely more on your debit card. So for debit card, for checks, definitely you need to have more money. So if you're going to use more debit card, more checks, then you are going to need more money, so your demand for money will increase. Makes sense? You have a right for shifting money demand. Okay, that was pretty much it about demand side of the market. Now let's look at the supply. So we had downward slope demand, right? Now let's look at the supply, and you will see that the supply is no longer upward slope. Okay, supply of money, let's first define it, and then we'll look at the shape. Supply of money shows the relationship between the interest rate. Again, remember that's a nominal interest rate. Whatever the bank is basically telling us, that's a nominal interest rate, okay? And the supply of the quantity of money that is supplied by the central bank, by the Federal Reserve. So the quantity of money supplied is the amount of money that the Federal Reserve basically is keeping at the money market. And that amount of money at the given time is fixed. Okay, so the only authority that can change this quantity of money supplied is the Federal Reserve. Okay, so no matter what the interest rate in this is in the market, this quantity of money supplied is fixed. Can you imagine the shape of the supply now? We do not have an upward slope supply anymore. Our supply of money is vertical, because it doesn't matter what the interest rate is. Okay, let me draw it for you. It doesn't matter basically how much the interest rate is changing in the market. Our supply is going to be fixed. So we have our interest rate here, and then I have the quantity of money supplied. I'm going to call it QSM. It doesn't matter if the interest rate is 1%, if it's 2%, if it's 3%, the supply of money is fixed. Let's say it's hundred thousands or billions of dollars, okay? If the interest rate is 1, the quantity of money supplied is 100. If the interest rate is 2%, the quantity of money supplied by the Federal Reserve is again 100 millions of dollars. So this is the shape of our MS, or money supply. It's vertical because it's 100 billions of millions of dollars. It's fixed by the Federal Reserve. If the Federal Reserve decides to change it, then we're going to change the location, basically, I should say, our money supply, okay? So this amount of quantity of money supplied in the market is always, always, always fixed, okay? And the Federal Reserve is the only one who can change it. Don't forget that, okay? All right, so we have a downward slope demand, don't forget. We have a vertical supply in the money market, okay? Now let's put them together to define our equilibrium, okay? If we have this downward slope money demand, this vertical money supply, the intersection of our MS and MD, just like chapter 3, just like chapter 12, will be our equilibrium in the market, okay? Just like chapter 3, we can talk about shortage and surplus. So if the interest rate is above if you look at the graph at the intersection of MD and MS, we have 5%, which is our equilibrium interest rate. But if the interest rate is above this 5%, like in this graph, 6%, then it means that we have excess supply of money, meaning that the supply, the quantity supplied is greater than quantity demanded, okay? So interest rate is high, so people are gonna buy more stocks and bonds, but eventually the interest rate will drop, right? Because the demand for bonds and the stock will go up. So eventually the interest rate will fall back to the 5%, just like the discussion we had in chapter 3. If the interest rate is below the 5%, if the interest rate is like, let's say 4%, then we are gonna have excess demand for money. The interest rate is lower than equilibrium. So people are not actually gonna buy that much stocks and bonds, right? They're gonna sell actually their stock and bonds because the interest rate is just too low for them. So demand for bonds and stocks will drop. So eventually the interest rate will go back to the equilibrium. Just like chapter 3, just like chapter 12, the market have this tendency to go back to the equilibrium. So every time we have shortage and surplus, the market wants to adjust itself and go back to the equilibrium. If it's the interest rate is just too high, the market will go some sort of transactions and functions, so we're back to the equilibrium. Same thing is going to happen when we have shortage or excess demand for money. We talked about equilibrium. We talked about the shape of MD, the shape of MS. We talked about the factors that can shift our MD, like price level, real GDP, technology, how we're going to use basically our money. But we didn't talk about the factors that can shift our MS. Remember that our MS, our money supply, will change only when the Federal Reserve wants to change it, okay? And anytime that the Federal Reserve changes basically the interest rate in the market, our money supply will change, okay? So if the Federal Reserve wants basically to change the supply of money in the market, the Federal Reserve will change the interest rate, okay? If this part is very, very important, guys. So if the Federal Reserve, let me highlight it, this part is super important. If the Federal Reserve increases the quantity of money, okay, quantity of money, our interest rate will drop. What does it mean? It means that the interest rate and the quantity of money move in the opposite direction, okay? And if the Federal Reserve decreases the supply of money, then the interest rate will go up. Let me clear this page so I can move on to the next slide to kind of show you how it works. Okay, let me move one step back. So this is our equilibrium. This is our equilibrium at the money market, okay? So now the Federal Reserve is trying to change the the Federal Reserve is trying to change the interest rate. The easiest way for the Federal Reserve to change the interest rate is to change the supply of money. Why? Because the Federal Reserve controls the supply of money. Remember, that's why we have the vertical shape for the supply. The Federal Reserve can also change the demand side of the market. Remember, obviously, if we change the demand, the interest rate will change for sure. But the Federal Reserve needs to change the demand kind of indirectly, but it's easy for the Federal Reserve to change the supply because the Federal Reserve is in charge of the supply. But don't make this mistake. Yes, the interest rate can change if we change the demand side of the market, definitely. But for the Federal Reserve to change the interest rate, is just easier to change the supply side because it controls the supply side of the market. So if the Federal Reserve, with all those policy tools that we talked about, can increase the supply of money, the supply will shift to the right, obviously, just like chapter 3. If supply increases, we have a rightward shift. If supply decreases, we have a leftward shift. If the Federal Reserve increases the supply of money, we have a rightward shift. So the supply is shifting from MS0 to MS1. Look at the new equilibrium. We are no longer at 5% interest rate. The interest rate is going to drop because we have a new equilibrium. The new equilibrium is at the intersection of MD didn't change, and MS1, our new supply. So the interest rate went down from 5% to 4%. That's the exact inverse relationship we were talking about in this slide here. Supply of money increased, the interest rate went down, and that's why. And vice versa, the supply of money decreases, so we have MS2, we have a leftward shift in supply. MD did not change, so the interest rate actually went up to 6%. So there is an inverse relationship between MS, changes in supply of money, and interest rate. And the easiest way for the Federal Reserve to change the interest rate is by changing the supply of money, because the Federal Reserve controls the market, the supply side of the market, okay? Now let's see when the supply of money is increasing, when the supply of money is decreasing, by bringing all those 3 policy tools we had for the Federal Reserve: the required reserve ratio, discount rate, and open market operation. Because these are the tools that the Federal Reserve has to change the supply of money and change the interest rate. Make sense? Let's see how the Federal Reserve can increase the interest rate. Kind of remind you, we are looking for basically decline here in MS, right? Because we know that the interest rate and the supply of money move in the opposite direction. So anytime that the Federal Reserve wants to increase the interest rate, basically the Federal Reserve is going to decrease the supply of money. The Federal Reserve can decrease the supply of money by increasing the required reserve ratio, by increasing the discount rate, or by selling government securities in the open market operation. So that's very important. If the Federal Reserve wants to increase the interest rate, the Federal Reserve should reduce MS. Let me write it down. The goal for the Fed, also check out the other videos that I have, okay, for this chapter. They're all on D12. Federal Reserve goal here is to decrease the MS money supply here, okay? If the Federal Reserve increases the required reserve ratio, the Fed is basically forcing the banks and financial institutions to collect more money from people's hand. So the banks are actually forcing their customers to give them more money, right? So the supply of money in the money market will go down because people are giving more money to banks. So the banks are in charge of collecting money from the market. So the supply of money will go down. If the Fed increases their discount rate, the Federal Reserve is putting pressure basically on banks and financial institutions to basically to borrow money from other commercial banks because the discount rate is high. So the commercial banks are not going to borrow money from the Federal Reserve. It's just expensive for them, right? So they are going to actually borrow money from other banks. They are going to borrow, they're going to collect more money from their customers. They need the money, but the Federal Reserve basically is just telling them, oh, it's just expensive. It's too expensive to get it from me. Go find it on your own. So the Federal Reserve is indirectly reducing the supply of money by asking banks and commercial banks and other financial institutions to get the money from other banks, from their clients, okay? So indirectly, the supply of money will go down. Another way for the Federal Reserve to reduce the supply of money is to starting that open market operation. Remember, the government securities are the Federal Reserve assets. So the Federal Reserve can sell these securities, right? They can sell it to us, to individuals, to public, through the New York, through the Federal Reserve in New York. So when they sell these securities, they are going to do what? When you sell something to somebody, you are going to get money in return, right? So they sell these securities to us, and then in return, they're going to collect our money. So the supply of money one more time will go down. So every time, to conclude, so every time that the Federal Reserve wants to increase the interest rate, the Federal Reserve should reduce the supply of money. How? By increasing the required reserve ratio, increasing the discount rate, or selling government securities. You can think about the opposite case when the Federal Reserve wants to decrease the interest rate. So if the Federal Reserve wants to decrease the interest rate, the Federal Reserve should find a way to increase the supply of money. Let me show you the next slide. These are the actions that the Federal Reserve should take if the Federal Reserve wants to decrease the interest rate. You can read it on your own, okay? So that's pretty much it. I know that I put also the quantity theory of money. No question on that. You can read it if you want, but it won't be on the test. So that's pretty much it about the chapter 14. What I want you to do is to review all these definitions. I know that there are lots of information in this chapter, but you will get some questions on the definitions, like about money, functions of money, what is the discount rate, what is the federal funds rate, what is required reserve ratio, the structure of the Federal Reserve, how many regional Federal Reserve we have, what is the role of FOMC. These are the important things. What are the policy tools for the Federal Reserve? These are the definitions you need to know. Know the structure of the Federal Reserve. I think I mentioned it. What else? Money market. It's super duper important. You need to understand the money market. You need to understand the demand and supply side of the market. We are basically talking about all those things that I mentioned so far to understand how the Federal Reserve policy tools can control the supply of money and how these policy tools can change the interest rate, okay? So you need to understand that. You need to understand the money market, and then you need to know how the Federal Reserve is changing things in the money market, okay? So I know that it was a lot of information, but try to go step by step, understand everything, if you understand the demand and supply in the market, then you can understand how the last part that we discussed, how the Federal Reserve can increase or decrease the interest rate. Okay, hope you find this video helpful. Go back to chapter 3 if you need to, if you want to basically review demand and supply, and let me know if you have any question. Okay, check out the other videos on D2L, and I'll see you soon.